Welcome and thanks for tuning into KBRA podcasts. We cover topical research discussions, industry commentary, and more. In this episode of KBRA's Structured Finance Outlook series, Keith Kockenmeister, Senior Managing Director and Co-Head of CMBS Ratings, is joined by Nitin Bhasin, Senior Managing Director and Co-Head of CMBS Ratings, and Roy Chun, a Managing Director in our CMBS department. The team will summarize what happened in 2020, the impacts of COVID on CMBS issuance, property types and CMBS ratings, as well as what to expect in 2021. Stay tuned to learn more.
Hello, everyone. Thank you for listening to our CMBS 2021 Outlook podcast. Today, we will cover several topics, including a summary of what happened in 2020, as well as what we think 2021 will look like. Let's start with talking about issuance volume. CMBS issuance started 2020 on a strong note as a continuation of steady economic growth, low unemployment, and tenant demand spurred the market. However, the onset of the coronavirus began to meaningfully affect the commercial real estate market at the beginning of March, temporarily halting issuance. The first post-COVID conduit launched in May after a 2-month dry spell. However, the pandemic threw cold water on what would have been a banner year for issuance, and the year ended at roughly $59 billion, well below last year and the lowest since 2012. Nitin, let's start with you. What do you expect issuance volume to be in 2021, and what will the drivers be of that forecast?
Sure, Kate, and hello, everyone. Hope you're staying safe. 2021, we expect issuance to be flat to 2020 at about 60 billion, while 2021, we're going to start seeing some recovery towards the second half of the year. 2020 numbers were propped up a little bit by, the 59 billion of issuance of private label CMBS that was propped up a little bit by Q1, an extremely strong Q1. And in the current year, Q1 is going to be fairly weak in terms of issuance. That's our expectation. Of that 60 billion, we're expecting about roughly half of that to come from single asset, single borrower transactions, and the other half to come from conduits. In addition to that, we're expecting about another 10 billion of CRE CLO issuance. So all in all, 70 billion of private label commercial real estate securitization.
Thanks, Nitin. When conduit issuance resumed in May, the pools were heavily sanitized with minimal lodging and non-essential retail concentrations. We even started to see some debt service reserves becoming the norm. Nitin, let's stick with you. What do you think conduit transactions will look like in 2021, and will they experience any structural changes?
I think 2021, we're going to see transactions that look somewhat similar to the second half of 2020. And I'll start with what those transactions look like. With the onset of COVID, we saw a decline in retail and lodging exposure in conduit CMBS transactions, as those are the two most negatively impacted property types due to the pandemic. And that decline, about a 10% decline in those property types, shifted to office and industrial. And we're going to see a similar composition in 2021, where pools are going to be more heavily exposed to office in particular, which was about 30% of CMBS securitization to begin with, and 2020 became 40% plus. So we're going to see high exposure to office and increased exposure to industrial, perhaps a little bit self-storage as well. In terms of pool concentrations and pool sizes, 2020 and 2021 will have slightly smaller pool sizes relative to 2019, owing to less supply of retail and lodging to core property types. That, for example, manifested itself in an average loan HERF of 22.9 for conduit transactions in 2020 as compared to a 28.2 loan HERF in 2019. The concentration will manifest itself not just in loan HERF, but more concentrated in office and industrial, as I said, in terms of property type, as well as geographic concentrations, right? For example, 2020 conduit deals saw the top 3 MSAs comprising 45% of pools, whereas in 2019, the top 3 MSAs were only about a third of the pool. So we'll continue to see that trend in 2021, where pools are concentrated from all different angles. From our analysis perspective, our haircuts have increased, cash flow haircuts have increased in pools from an average of 7.1% in 2019 to 9.7% in 2020. That trend will continue. We expect that to continue as at KBRA, we're stressing cash flow more to reflect kind of ground reality collection rates in assets. We're using higher credit loss, higher vacancy numbers, and in certain cases, higher expenses as well. That's leading to higher cash flow haircuts. So we'll continue to see that trend. From a leverage perspective, we did see a slight decline in leverage, whether it's measured by appraisal LTVs or KBRA LTVs, KLTVs as we call them. We saw a slight decline in that in 2020 relative to the years leading up to the crisis. However, that top line lower leverage number by a few points was really owing to more credit barbelling in transactions, whereby there is a higher proportion of investment grade loans and lower leverage loans in pools. From a low leverage loan went up from a 30% exposure in pools to about 40% exposure. Whereas the higher leverage loans, we didn't really see a decline in leverage in sort of what I call the regular conduit loans. If you exclude the low leverage IG loans, the rest of the 70% of the pool still had similar characteristics of about 65% appraisal LTV loans. So that risk is and leverage is somewhat similar to pre-COVID. So that hasn't changed. We don't expect that to change, even though the headline numbers may indicate a lower LTV. Another thing that we did see, and I expect to continue to see, is a rapid increase in interest-only loans and interest-only periods in transactions. And that, while that was a long-term trend where the IO periods in transactions have been increasing slowly but steadily since 2012 through 2019, we saw a rapid shift in 2020 owing to stress on cash flows, which the loan originators and issuers try to offset a little bit of that with originating interest-only loans, thereby, at least for the near term, causing a higher debt service coverage. While that may be a good thing for the near term, as with interest-only loans, and low interest rates leads to high debt service coverage ratios for the near term. Over the longer run, that just pushes the risk down to the future, as the loans won't amortize down, and you're sort of trading near-term risk by pushing that risk into the future. One structural change that we did see was loans being originated with debt service reserves. Post-COVID loans in the second and third quarter of 2020 saw about 40% of those loans saw debt service reserves. That number rapidly declined to only about one third to a quarter of loans originated in Q4 of 2020, seeing debt service reserves. We'll continue to see debt service reserves in 2021, but at a declining pace. So those are some of the high level trends we've seen from a credit perspective and structure perspective, and we expect to continue to see those in the next year.
Great. Thanks for the info, Nitin. The pandemic and its impact on the economy and commercial real estate continues to unfold. The resulting implications on commercial real estate will tend to vary by property type and market. The extent to which property revenues may be impacted will be a function of whether longer-term leases provide a buffer against potential declines in rent and occupancy, or if cash flow is derived from revenue streams that are of a shorter duration or from struggling tenants. With that in mind, let's talk about the recovery outlook for various property sectors. Roy, let's start with you. Why don't you give us your thoughts on the multifamily and industrial sectors?
Sure, Keith, and hello to everyone. And I thank Keith for giving me the easy ones. I think the overall outlook remains pretty positive for both sectors. We'll start with the multifamily. Affordability and availability of single-family homes will continue to bolster the rental market. That said, you can't divorce the multifamily from what's going on in the economy. And Reese is predicting that vacancies will go up. I think Q3 2020, it was 5%. They're predicting it to go up to 7% with a slight decline in rents. New supply pace is still pretty robust, and that's just offset by weak absorption due to the impacts on income, employment, and household formations because of what's going on with the economy, the effects of the pandemic. A good sign that we see kind of confirming what's going on in the multifamily space. We still see, like in our CR CLOs, where many of the loans are multifamily and they are still achieving their business plans. And we see many of the CRE CLOs that we rate, the multifamily continue to perform fine and meeting their business plans. We do expect Class B will outperform Class A multifamily. Class A renters, either because of their situations, they may move down to Class B, or they have the flexibility to move out into single family homes more so than probably Class B renters. So what we do expect Class B to hold up better than Class A, and we do see a lot of disparity across markets. Obviously, markets like New York and San Francisco, where the pandemic has been particularly hard, and some of the restrictions have been more limiting on people's movement and things that they can do. We have seen declines of 7 to 10% in rents across those broader markets, but valuations continue to be strong through the pandemic. Multifamily prices continue to rise, and Real Capital Analytics, they're showing pricing through the pandemic on multifamily still continue to rise, and really driven by outside some of the larger metros, which has been a trend since 2016, but more pronounced in 2020 as people looking to invest in more suburban type multifamily. And certainly new stimulus will help with renters. On the industrial side, been a darling of the industry for a while now, really led by the performance of warehouse and distribution. Obviously, with the e-commerce, warehousing and last distribution becomes really important, especially in the major markets. And we see RCA reporting that prices in the 6 major metros are definitely outpacing pricing in industrial nationally. So again, pointing to the need for that warehouse last distribution in these larger metro areas. On the other side of the industrial, kind of the more flex R&D, like manufacturing space, you can't divorce their performance from the impact on the economy. And we have seen slower leasing activity in that space, like office, where companies are holding back, expanding, or entering into new leases with some of the uncertainty. But overall, new supply is also pretty strong, so that'll limit rent growth, and upward pressure will be there on some of the vacancies, as Reese is also projecting a slight increase in vacancy levels in that area because of the supply growth. So that's what we got for multifamily and industrial.
Thanks, Roy. Nitin, let's turn to you now. What do you think about the outlook for lodging and retail, two of the hardest hit sectors from the pandemic?
Sure, thanks, Keith. Look, the lodging industry experienced an unprecedented period of expansion, achieving 10 years of straight RevPAR growth during 2009 through 2019. As 2020 approached, the sector already started seeing and are showing some signs of stagnation, with certain markets such as New York that were hobbled with new room supply. From that peak, the COVID shutdowns brought never before seen declines to the industry, with RevPAR dropping like a rock, almost 80% in just 2 months. Since that decline, the industry has partially recovered, with the second half of 2020 seeing some recovery. However, that recovery has been bifurcated, and bifurcation of performance is one of the themes that we have seen and will continue to see across all property types owing to COVID. Extended stay assets in particular, some limited service assets, and assets where folks can drive to instead of fly to have rebounded quite a bit. In some instances, those properties are back to their pre-COVID levels. At the other end of the spectrum are luxury and upscale hotels, group hotels, lodging properties that cater to conferences, and assets located in dense urban markets. All of these continue to struggle with distressed occupancy levels. Some of these, in fact, assets may never open doors again. These are the hardest hit asset types within lodging and will take the longest to recover. Looking forward, let's use history as a guide. After each of the last couple of downturns, the global financial crisis of 2008 and 9/11, 2001, it took about 4 to 5 years every time for lodging's RevPAR or revenue per available room to rebound to its prior peak levels. We expect a similar pattern this time, especially with the most negatively impacted pockets within lodging. And as such, a full recovery to 2019 levels may only be achieved by 2024 or 2025. Switching over to retail, the retail sector was already struggling for a few years before the pandemic. Rents and vacancies and values were already coming under pressure in certain asset types, particularly malls. And this was owing to the long-term secular trend of consumer spending shifting away from brick and mortar stores to online stores. COVID dramatically accelerated that secular trend. The shift that was expected to gradually but surely happen over the course of a decade suddenly happened within a course of a few months. It was sudden and extreme. The pandemic, while accelerated that secular trend, it also decelerated some of the positive demand drivers in retail. For example, one of the positive trends that was a demand driver pre the pandemic for retail was expansion into experiential tenants, and that was suddenly halted, and that trend is going to reverse and slow down for sure in the coming years as people will be hesitant to congregate in mass in these experiential spaces. As a result of this, we expect retail vacancies to continue to trend upwards, rents to continue to decline over the next year. 2021, we expect to have negative absorption, and that's despite tempered new construction in the sector, before returning to perhaps a positive territory of positive absorption in 2022. Among the major retail categories, malls, as I said, that already were impacted the most and will continue to be impacted the most. In fact, a recent study that we studied about 600 appraisal or reappraised values on specially serviced assets across various different property types, where we compared the new appraisal values of specially serviced assets relative to what the appraisal values were for those properties at securitization and what their delta was. While the average decline in value of these reappraised assets was 30% across about 600 reappraised values, the average decline for malls was 60%, twice that, right? So that tells the relative negative impact that malls have been experiencing relative to other distressed assets. Other sectors within retail that are outsizedly negatively impacted include department stores, apparel retailers, and experiential retail I've already mentioned, such as movie theaters. Conversely, some areas of retail are doing fine and will continue to do fine. Grocery stores, home improvement stores, drugstores, dollar stores, discount stores, mass merchandise stores such as Costco's and BJ's, they're going to continue to perform well. On the restaurant side, it's also interesting. When COVID hit and shutdowns happen en masse across the country, the collection rates and the rental collection rates in restaurants declined substantially, where they went down below 50%. Since then, however, in some of those sectors, rental collection rates have rebounded to close to 100%, 95 to 99%. And the bifurcation there is quick service restaurants and casual dining places. Those have rebounded and are outperforming on a relative basis the high-end restaurant chains, which some of which may still be closed, while others are be struggling with lower occupancy levels and lower sales. So that's kind of the retail landscape as we're seeing going forward, Keith.
The last property type that we want to talk about is the office sector, which generally tends to lag the overall economy due to the longer-term nature of the leases. Historically, a decrease in asking rents generally lags the beginning of a recession by a few quarters, Landlords generally will initially attempt to offer concessions when faced with rising vacancies and available sublease space, but ultimately they will lower their asking rents. With that in mind, we do expect negative pressure on office rents and leasing velocity, especially in central business districts that are dependent on mass transportation. There are several secular trends that are emerging that could influence demand for office space. Following many years in which more workers were placed in open layouts, which required less office square footage, employers may require more square footage per employee to accommodate physical distancing. However, this could be counteracted by fewer workers commuting to the office, reducing demand as the work from home trend continues. So let's move on to another topic, one that has been in the forefront for us during this pandemic, and that's the surveillance. Roy, can you summarize our ratings actions from 2020?
Sure, Keith. Yes, it's been a very busy year. Going into the pandemic, we said and viewed that the severity and the breadth of the impacts and the ratings would really be influenced by the length and extent of measures needed to control the spread of the virus. So we took a measured approach as we kind of went into the year, and it's kind of demonstrated by our actions. In March of 2020, we put out a release that had all our SASB retail mall lodging transactions. We said they would underperform given what we saw going on. And then in May, as things progressed, we put about 45 classes across 14 conduits on watch. Those watch downgrade, those were transactions that were underperforming even before the pandemic hit. And so we knew those would be more susceptible to potential rating actions. And then as the pandemic continued and some of the lockdown measures became more severe and more widespread, in July, we put 146 classes across 41 deals on watch. And then as we kind of reviewed deals, we also took actions directly on those ratings. So all in, when we look back at 2020, we had 292 downgrades, which is more than the past 9 years of KBRA's ratings, 3 times more almost. And those 229 downgrades represent about 6% of our ratings. They were across 80 deals, representing about 22% of our rated portfolio. Downgrades are still concentrated in below investment grade, where we saw about 28% of single Bs, 18% of double Bs getting downgraded. Triple Bs are just under 10% of the triple Bs have been downgraded, and then only 1% of, when you look at all A's to triple A's, only about 1%. It's only a small handful. On the SASB side, I'll go into this in a little more detail, where we saw, on our retail malls, we probably have about 24 SASB mall deals. 10 of those 24 were had ratings downgraded in 2020. And then on the lodging side, we have 14 SASB lodging transactions. 6 are currently on watch and 2 have been downgraded. So a pretty large proportion of the lodging, as Nitin was talking about, highly impacted sector. We haven't downgraded everything yet, but we do have a 6 out of 14 on watch, kind of looking to see how things kind of progress in 2021 on those deals. On the positive, Freddie Mac deals, delinquencies still very low. We didn't have any downgrades on those. On the CRE CLO space, we didn't have any downgrades. Delinquencies are less than half of what the other CMBS delinquency rate is. And some of that's partly due to relief granted to the borrowers, but those loans were generally kind of structured with expectations that they would be underperforming during the business plan period. So they had reserves and other features that kind of allowed them to at least not go delinquent during this period, and the flexibility on the managers to work with the borrowers to kind of keep the loan current. And then also a positive is single family rental, where we actually had 29 upgrades that were through a combination of deleveraging, but we definitely saw kind of rent growth and property appreciation continue in that space, and demand still seems to be robust as renters look for more indoor and outdoor space, leaving maybe apartment buildings, 1-bedroom apartments to be in a single family rental where you have more space. So that kind of summarizes how 2020 went with ratings.
Great, thanks, Roy. So with that backdrop, we have a pandemic that is continuing to rage and vaccines that are slowly being rolled out. Roy, again, can you tell us any actions we can anticipate over the next 12 months?
Oh, as you mentioned, it's got to be dependent on that rollout and the confidence in the vaccine, and how lodging and retail, the two most impacted sectors, will bounce back. But at this point, we don't have many deals on watch downgrade. In total, as of today, we have only about 8 SASB large loan deals that we have some ratings on watch downgrade. We've gone through our conduit book through 2020, but that's not to say that we won't see more. We'll continue to monitor the book and look for deals that are more stressed. We do expect more downgrades are likely, especially when you consider just the magnitude of what's been going on in the economy. And when you think about, yes, we've had a lot of downgrades, but if you look at 30% of single Bs got downgraded, that means there's still 70% that never, that we haven't downgraded. So to the extent that, this pandemic drags out and the impacts on the economy drag out, we do expect to see potentially more downgrades, and some of the severity of downgrades, 10% of the triple Bs being downgraded, we do expect some of those numbers to increase, but they're going to be deal by deal at this point. We don't expect to put a bunch of deals on watch downgrade, but that will be necessitated and looked at as we kind of go through 2021 to see if we need to do that. Again, a lot of it's just going to be dependent on how lodging and retail, the two most impacted sectors, bounce back.
Great. Thanks again, Roy. And thanks, Nitin. That concludes our podcast. Thank you all again for listening in. And if anyone has any follow-up questions, please feel free to reach out to any of us at your convenience. Thanks again.
This concludes our episode. Please continue the conversation on LinkedIn and Twitter @CrowBondRating. We'd also like to remind you that all of our ratings and research reports are free at KBRA.com. Lastly, please share your ideas for future podcast episodes or any feedback to media@KBRA.com. We hope to see you next time.